Liz Ann Sonders is back with us, Chief Investment Strategist at Charles Schwab. Okay, Liz, we got you back. Let's talk here about what's happening as we see our numbers start to soften up just a tiny bit. Should investors be concerned about some of the misses that we've gotten here and some of the early kind of slowdown we've seen in some of this high-frequency consumer data?
I think it would be expected. There was a lot of euphoria around what were the back-to-back Monday vaccine announcements, which I think is valid optimism. I think it sort of moves ahead the time frame where we can start to get back to normal. But the problem is, even if that is the light at the end of the tunnel, we're still in the darkest part of the tunnel with regard to the resurgent virus cases. And even absent mandated lockdowns, there's human behavior that may actually be even more inclined to retrench, given the time frame having been shortened by virtue of the vaccine. So we've been saying we've kind of got this rolling W's nature of a recovery on an ongoing basis, where you have fits and starts largely driven by the virus. And I think we happen to be in one of those right now. So seeing things like the weaker than expected retail sales, I think that was preceded by a lot of those high frequency indicators that suggest that we were in a bit of a retrenchment.
Now, there's been one example where we've kind of seen something like this. It was in the summer. In June, we had a real strong bid into a lot of the reopening style stocks and back to normal stocks. That's kind of been the high now for months. Some of these companies and sectors are now reaching above that level. One of the charts from Evercore that you tweeted out, I love this because it shows kind of this similar type of pattern through retail sales where we got that push again and then a pull back. Maybe that W that you described where we kind of launched forward again. This time, maybe we've got a similar situation setting up, but what's an investor to look at? I mean, how do we know what our inputs here are? Is it just waiting for the economic data? Can we project out from things like employment? Because to some extent, it feels like that has fallen short a little bit, right? People have spent even though they're unemployed. It seems like some of our numbers that maybe in the past were reliable to get a gauge on what people are going to do they hold up? I mean, what's the information investors to look at to try and glean how bad this one could get this time?
So first of all, I think understanding the nature of leading indicators versus coincident or lagging indicators is always important, especially in this environment. And I think there are leading indicators that lead the traditional leading indicators that are maybe very unique to this particular crisis, like a lot of the mobility data. I think what may have happened, certainly in the June timeframe, is we were in the midst of enthusiasm, given that what we initially saw looked like V-shaped recoveries in a lot of data. We saw it in retail sales and industrial production. We saw it in a lot of labor market data. But that simply was math. That was the nature when you shut an economy down and you compress data to such a significant degree, the initial percentage increases are going to be massive. There shouldn't have been any extrapolating of that, because even without a resurgence in the virus, the math was such that you were not going to repeat those kind of numbers. And then you add to it a resurgence in the virus, and you are seeing this choppier market action. I think specific to the labor market, the indicators that I would pay most close attention to are not necessarily the standard indicators like initial unemployment claims and payrolls or the unemployment rate, but temporary job losses versus permanent layoffs. The former has been coming down because most of the payroll gains we've seen have been people getting their former job backs. Unfortunately, permanent job losses are going up. Preceding that, of course, would be things like layoff announcements and bankruptcy filings, both of which continue to surge. And then in terms of unemployment, it's certainly good that we've seen a huge move down in the unemployment rate, but long-term unemployment, 15 weeks or more, 27 weeks or more, that continues to go up. So those would be in particular, the labor market metrics that I would keep a close eye on, particularly over the next several months.
Is it an issue that we are kind of testing the foundation of our recovery again on this kind of fundamental basis of COVID plus jobs and stimulus, the kind of jobs plus stimulus, what that nets out to, combined with the COVID cases? Is it a problem that we're going to be kind of testing our stability right when it seems sentiment is picking up, Liz? I mean, we've got this great vaccine news, but then I look at things like flows, and I look at the AAII survey, and it's like sentiment just took off again right at a moment where it seems like maybe we're going to be a little fragile if we don't get another dose of help from the government.
Well, I'm less worried about the choppiness in the economic data. I think that was to be expected given the nature of this crisis.
Okay.
Especially now, given the resurgence of the virus, until the point we not just have the initiation of a vaccine, but actually seeing its longer term efficacy and getting it into the arms, so to speak, of many people. What concerns me more recently, to your point, is that sentiment has gotten stretched. Now, we've seen it by certain cohorts. We've been calling the newly minted day traders in areas like the single stock options markets and some of the high momentum names. But more recently, particularly given last week, you started to see it in more traditional sentiment data, the AAII bulls, which went stratospheric. You started to see it in fund flows. So what had been sort of pockets of speculative fervor wasn't matched by a lot of attitudinal measures of sentiment or other behavioral measures of sentiment like fund flows. But last week, you saw a surge in all of those, and you're starting to look at a collective sentiment environment that's akin to what we saw back in January of 2018, which of course preceded what we now think of as the Volmageddon period of weakness. So I actually am more worried about that factor than I am the choppiness in the economy. I think that was to be expected.
Now, what does that worry imply? Is it the potential for just kind of non-fundamental price correction and valuation correction? I mean, 2018, we started talking maybe about potential rate hikes and the Fed moving off, and you could possibly tie that as a catalyst, but really it just seemed like it was untenable froth that just kind of exploded at one point, and then all these products unwound. We don't have those same kind of products now that maybe could create that situation, but we do have higher valuations. I mean, we've got tech that on the news of a vaccine, some of the best news that possibly anybody could ask for right now, and it's sending the NASDAQ down on those events. We're seeing 20, 30% drops in companies that were trader and investor favorites for 6-7 months. How much of a problem is that, Liz, that this really good news is right now barely positive for the market overall? I mean, we're up like 2%.
Well, I think that any correction in the excess could be manifested in a rotation type environment. And that's exactly what we've been seeing in fits and starts since early September. If you in particular look at the largest 5 stocks in the S&P, which have gotten rightly so lots of attention, and you track a rolling, daily year-to-date spread between those and the other 495 stocks in the S&P, that's kind of a proxy for this speculative fervor we're talking about. That spread peaked out at more than 60 percentage points on September 2nd, which was that first surge to all-time highs in both of those indexes. Since then, that spread has been rolling over, not in a straight line, but again, we've had these fits and starts of kind of correction via rotation, where in the 3-week pullback in September, we didn't see the major averages go into correction territory, but we certainly did among those names and some other of those high momentum names. We've seen that again more recently. So there is a somewhat benign scenario where you can bring down some of the speculative fervor without taking the market down with it. But again, my concern is that some of the sentiment excess is no longer in pockets. It's a bit more pervasive. That in and of itself doesn't suggest we're going to have a contrarian move. It just sets up greater vulnerability to the extent there's some sort of negative catalyst. And in some cases, it could be a negative catalyst that has been one on an ongoing basis, but for whatever reason was taking a back seat to sort of the speculative fervor around the momentum. I'm certainly hoping that we continue to see this benign scenario of easing some of this excess via rotation. But if we got a more negative catalyst outside what the sort of threads and narratives that we're already dealing with, unless sentiment pulls in advance of that, I think that's a risk factor for the market.
I like the way you put that. I think it's really good. The benign kind of correction of those valuations, right? It's benign for the overall market because it seems that equities, U.S. equities as an asset class, still have the draw, where investors will take that money and they'll just put it into different U.S. equities. So right now it's netting out slightly positive, up a couple percent since the Pfizer news. The NASDAQ's still off those September highs. But Liz, I'm curious for an investor who's thinking here longer term, who's been watching this market just deliver year in and year out for a decade. That Big Five chart that you've got on your latest letter, the one you just talked to us about, the FANG, the Big Five, leading the rest of the market, I mean, that thing has basically gone in one direction. So if it has peaked for the time being, is that going to limit the upside? Should that make investors reconsider the rate of return they should expect over time if the big horses that have been drawing this carriage for a decade right now are shifting and becoming laggards?
Well, it certainly could limit the upside, because at that September peak, those 5 stocks represented almost 25% of the S&P in cap-weighted terms. So they were basically their own quartile. Now, the underperformance that they've seen has not been dramatic in an absolute sense. So it's not, again, causing a major downdraft in the overall indexes, and the other sectors that have gotten a lift, like you saw last Monday and Tuesday, like you saw yesterday with energy, with these massive gains, financials secondarily to that. It's also why that has fed into much better performance in the last couple of weeks for small caps and value. It's more about that sector rotation into areas like energy and financials that are so much more dominant in those small cap and value indexes. I think that has led to this narrative that this is a big growth to value shift. It's just a shift to parts of the market that hadn't been performing as well. In the case of financials, which are really dominant in areas like small cap value, particularly Russell 2000 value, that I think was largely based on the move up in Treasury yield. So there's a lot of ways we really should be slicing and dicing, and some of these very simplistic narratives I don't think tell the most appropriate story. That said, this shift to areas that would be considered more classic cyclicals, I think they'll continue to be in fits and starts until we really get a sense that this trajectory of the economy improvement is not just a hope based on vaccine, but actually starts to kick in. I don't think we see the rotation persist until we have real traction again in economic growth.